Purnima, it's great to have you on the show. Welcome.
Hey, Sarah, thanks.
I'm curious, what, as someone who looks at the credit market and the bonds of some of these companies, what you made of the target warning and what some of the ramifications could be for the economy and for earnings estimates.
We're seeing this a lot with a lot of companies, which are talking about some of the cost pressures, which are impacting margins. So, there's been labor cost pressures, freight cost pressures as a result of energy prices, shifts from discretionary spend to non-discretionary spend, shift from goods to services and experiences. So I would say a couple takeaways. One is we've seen a lot of it. We've seen labor reduction in labor needs. We haven't seen a lot of layoffs yet, so that would be one thing. I think two is we have seen some margin pressure. Companies have hung in there, but their outlooks are a little bit more. They're a little bit more concerned around their outlooks, and we've seen that pretty consistently. And three, we've started to see some of those shifts and their inability to pass through pricing entirely, so it's hitting margins. So we're seeing a lot of that, and we focus on credit over here, but we're watching all those trends.
No, what is the credit market telling you? Is it as sort of pessimistic about the economy, or at least does it feel as pessimistic as what the equity market has been doing lately?
It doesn't feel as pessimistic. Credit market spreads have not moved so dramatically. So I think everyone knows, high yield is down 7% this year. Treasuries are down 10%. So most of that high yield move has been a function of the Treasury market move. In terms of actual credit spreads, you haven't seen credit spreads move out so dramatically. And in fact, if you look over sort of the cadence of time in the range of post-GFC, most asset classes in credit, whether that be investment grade, high yield bonds, levered loans, are still trading, inside of their median spreads.
And the market has been open. Yesterday, I think, was one of the busiest days, right, of the year. It's like I have 12 borrowers pricing $15 billion across
the market is open.
15 tranches. What does that tell you?
It tells me that the market's very orderly and functioning. So the credit markets are definitely functioning. There's been some hiccups along the way, and there's been some weeks along the way where the market has not been open for issuers to do financings. But in general, I would say, with some minor concessions and repricings, the market's open, and we're seeing a lot. Certainly, in the investment grade market, I would say the high yield market and loan market is less open. So the levered credit market is less open, but definitely the investment grade market, you're seeing a lot of deals get done.